You know, I'm always brutally honest with you guys. I'm not gonna lie. I'm not gonna fake my opinion of something because I think it'll give me some more views. I don't do it, okay? We're gonna look at Uber earnings, and it's a company I've been pretty harsh on in the past. I really have. I'm brutally honest with my opinion of it, but I'm always looking to have that opinion changed at any time, right? I'm always looking for it. Stock obviously reported earnings yesterday after hours. So we're going to take a look at these earnings, see if this can sway my opinion a little bit. Obviously, the stock's down 2.5%. Early trading so far, nothing too crazy. So again, it's not like a massive swing that I would necessarily blame an earnings report for. But we'll look at these earnings. Let's look. Okay. They post a GAAP EPS number of negative 54 cents, which is a beat by 1 cent. But again, I've always said I really don't have a I don't enjoy unprofitable companies for the most part, and a company as unprofitable as this, pretty disappointing, but it is honestly better than what I expected. I can't lie to you. For Uber, I did not expect them to even hit their goal EPS line of 55 cents negative. Obviously, I didn't think they would do it. So I'm kind of impressed by those numbers. I'll be completely honest there. And the revenue line of 3.17 billion, down 15.5% year over year. It's a pretty big miss, down 390 million from the estimate. It's a pretty rough miss, I can't lie. One thing I do find impressive on this, I think you still need to mention it, where other companies like Lyft, who are one-dimensional, saw a 50% decline in revenue. Uber was able to limit that to a 15.5 because of the diversity that this company has. Obviously, they have multiple different platforms, including Uber Eats, freight, and such as that. So that's a positive aspect really for this one. Yeah. Gross bookings came in at 17.15 billion versus a consensus of 17.2. Not crazy. Consensus trips came in at 1.44 versus 1.369 consensus. So there were more trips than expected, which is kind of a shocker to me. I really didn't think that they'd be doing that much business this quarter, still with everything going on. I just don't see the rideshare segment being quite significant. It's a segment that's been very much hampered right now by everything going on. Monthly active platform customers came in at 93 million versus 92 million consensus, so it is a beat on that aspect. So that's impressive stuff there. Looking a little bit more in detail, obviously we saw gross bookings. Delivery bookings topped 10.05 billion, which is an increase of 130% year over year. Pretty massive. Again, delivery is where it's at. I mean, I told you, Uber Eats, baby. Yeah. Mobility missed, though, with 6.79 billion versus a consensus of 7.3, down 47% year over year. So that's, again, where you see the discrepancy there, as I mentioned. I told you that, but the inclusion of Uber Eats on this is massive for this company because that's the only reason why their revenue didn't fall 47% year over year. So pretty cool in that aspect for them to have that diversity. Net loss was smaller than expected at $968 million. Fudge me. You know, I say it every time. These numbers shock me. This company loses billions of dollars a quarter. To see it under $1 billion is a positive thing, but the consensus was even $1 billion loss. I just hate that. I really just don't like that. That's what scares me off about this company is that I don't know how they're funding this. Obviously, it's in a lot of debt. It's just crazy. And to see a business that's been hit so hard by everything, to see a net loss line that big still is concerning. So that's where the brutal honesty comes in. I mean, I can't lie. What's crazy, I don't know what they're talking about here. Hear words from the CFO here saying that they're on goal to achieve profitability goals in 2021. I just don't see it happening. I don't see how it's possible that they could hit profitability goals when obviously their main segment right now is going to be Uber Eats. And to be frankly honest, that's not a profitable segment for them. Rides is the profitable segment, and it's not going to see recovery in the first 2 quarters. I can assure you that. It's obviously there's again the CFO here says these words to try to sell the stock. I get it, but I just don't see it happening. That's where some positivity comes in for this company, is that there's even price targets raised on this company because the CFO has said that they're going to remain their goal for this year. I just don't see it happening. If they do, I'd be mighty impressed. And obviously, it's a stock I look at every single week, every single earnings report every quarter. So I'll be interested in looking at that for sure to see what that looks like. Revenue grew 13% quarter over quarter, but down 16% year over year. Not that crazy, but again, most of it was due to 128% year over year growth in delivery, while mobility shrank 47%. You hate to see that. Net loss was not looking good. And again, as I mentioned this, so mobility adjusted EBITDA came in at a positive $293 million number, while the delivery segment came in at a negative $145 million, which is an adjusted number. That's my main point here in terms of this profitability goal, is your main segment here, Uber Eats. Let's be real here. If it's not a profitable segment and it's taken over as your main segment, I don't know how you could possibly get profitability. I don't know if they plan on turning that around, but we'll see what that looks like. I mean, it's something you got to mention. You got to mention it. The numbers, not awful. Trips only down 24% year over year for the full year isn't as bad as I might have expected. Monthly active customers only down 16 as well. Not quite as bad as I might have expected either. Gross bookings, to see only a 5% decline year over year is really massive, but again, that's entirely due to what you saw there. This is the line that scares me, this net loss line. Coming in at last year at $1.1 billion, now still at $1 billion. I mean, they barely shrank that line, increased by 12%, but they need some drastic growth there. In a year, I just don't see it happening. Maybe I'm crazy. Mobility shrank 61% in terms of that adjusted profit line. Delivery did increase, and they might see profitability in the delivery segment. We'll see what that looks like. I don't know. And again, that's off an adjusted EBITDA standpoint as well, so completely different from the non-adjusted. They might be getting some non-GAAP profitability, I guess, adjusted, but there's no way we see GAAP profitability this year, if we're being completely honest. And again, from the full year perspective, 27% decline in trips. That was quarter over quarter. Yikes. 27% decline in trips for the full year. Gross bookings down 11. Revenue down 14. Net loss for the year was $6.7 billion. This company in a year last year lost 8.5. I don't know how this company even exists at these levels when their revenue line's not even been close to that ever. I don't know. For me, that's just crazy. You're talking about a company that they definitely decreased by $1.8 billion on that aspect, but they still lost $6.7 billion. They've got 4 more years in order to reach those goals then, if that's the case. Son of a gun. Am I going crazy here? That's so much money lost. I'd be retired 50. Everyone in my family would retire for 50 generations with that much money. And they just lost it. Just out the window. And the adjusted EBITDA, not even that much better. Only 7% increase there for the full year. I don't know. That's just... I don't like that. Just being brutally honest. I don't like that number. And I can't consider an investment in this company with numbers like that. Son of a gun. So obviously from a breakdown, let's see, do they do a full year on this? No, they only do a 3 months ending here. So if we're looking year over year in terms of quarter, mobility shrank 50%, delivery grew 130, Freight grew 43% too, which is pretty nice. It's a small segment of their business, but not too crazy. But obviously, the delivery segment growing 100, doubling, it's massive. It's massive for that company and what they're able to do. So again, no profitability really in any segment besides mobility, which saw a 61% decline in terms of that. By geography, you did see EMEA saw a 25% increase, and Asia Pacific saw a 70% increase. Smaller segments, but Latin America really shrank by 43%, quite a bit. But again, U.S. and Canada make up the most of the revenue here, down 26%. They give some highlights on some of the stuff there. Nothing crazy. I do want to look at the balance sheet too on this company to see what a $6.8 billion loss means for them. Who knows? So let's see. Total current assets on the company. We're looking on the right-hand side. We saw quite the shrinkage in terms of cash and cash equivalents this year. Total current assets right now sitting at $9.8 billion compared to $13.9 billion. Really $9.9 billion, I guess. So that shrank solid $4 billion there in terms of that, but that was all due to cash and cash equivalents. Total assets in general actually did rise, $33.2 billion compared to $31.7. Most of that due to, from what I can tell, an increase simply in goodwill. So interesting. Liabilities on the company. You know what? It's not crazy. Total current liabilities didn't rise by all that much. Total current liabilities sitting at $6.8 billion compared to $5.6 of the year prior, and total liabilities in general came in at 16 are sitting at 19.5 compared to 16.5 of the year prior. So all things considered, it's not horrible. It's not horrible in terms of this balance sheet. I don't like there's quite an amount of deficit there. I mean, there's no doubt. But actually, there's stockholder equity here of $12.9 billion. Quite impressive. Now, it did decrease $2 billion year over year. But when you talk about a net loss of $6.8 billion, it's not that awful in terms of the grand scheme. So again, the company's definitely got it's got cash still on hand. Long-term debt obviously sitting at $7.5 billion. Not the most beautiful thing because they're raising capital quite a bit. And obviously a lot of that's going to be in senior notes too. When those expire, obviously, I believe the first ones don't really expire until 2024. I'm pretty sure, or 2023. So they have a while before those actually expire, and they have to pay on them. So if they do achieve profitability by then, I'm not too scared. But if they don't, that's where this balance sheet kind of gets decimated. But I don't think it will. I really do think that they'll be able to reach that profitability goal in time, potentially, to where at least it doesn't impact them quite as much. Again, I talk about this company a lot. Market cap at $113 billion. When you saw an annualized revenue of $12 billion, I just can't get into that. We're talking about 10 times the multiple there. No profitability. I can't get into it right now. Again, if they achieve profitability, this company it'll go long ways. But even if you look a year out, this company's core business shrank incredibly. The core business shrinks 50%. I mean, now you saw overall revenue only decline by 14, I believe it was, but in a year in which the revenue declined 14%, the company grew the stock price 50%. I don't know if I'm the only one seeing things that are a little bit weird there, but I just don't see that being sustainable in the long run. So I think this stock could be in for a rude awakening, or it might not because the market's smoking some good stuff. Let me just tell you that. They're smoking something that you might want to be a part of. But that's what I got for you today. Hope you have a good one.